Hello everyone, my name is Winfred Adundo and welcome to my final project presentation for Banner 7380 Advanced Business Analytics. Today I'll be walking you through an analysis of the US housing market, focusing on how home values have evolved over the past 2 decades and using Excel. So this project explores how US housing prices have evolved over the past 25 years and what key economic and seasonal factors help explain those changes. So to do this, I pulled together data sets from Zillow Research website, which provided monthly median home values from 2000 to 2025, and from the Federal Reserve Economic Data website, popularly known as the Fred's website, which supplied the mortgage rates and the consumer price index rates. I also had an unemployment rate, but I didn't get to use it. So after excluding New York and Illinois, Chicago, as required, I focused on 8 diverse states across the US, and I used Microsoft Excel to generate like the 4 key insights. So the first one generally looked at the 10-year home price growth, and I'll be showing you the insight shortly. My second insight focused on the mortgage rates and how it affected the prices for the homes. And my third insight looked into the effect of inflation on the prices of the homes. And finally, I checked on the seasonal analysis of like when is the best time really to buy a house. So overall, purpose was to go beyond headline price growth and explore deeper, often overlooked housing dynamics across regions. So here is my first insight. And this bar chart highlights the 10-year growth in median home prices across 8 US states from 2015 to 2025. As you can see, Florida and Georgia experienced the highest appreciation at a rate of 126.1% and 122.9% respectively. And in contrast, Pennsylvania lagged behind with only a 72.6% increase in home prices over the same period. So this demonstrates a significant regional variation, with over 50 percentage points separating the fastest and slowest growing markets within these states. So the 50% spread illustrates an even impact of regional economic factors on housing markets, and this insight underscores the importance of geographical consideration in real estate investment strategies. So my second insight involved me examining the correlation between 30-year fixed mortgage rates and home price trends from 2000 to 2025 across 8 states. So as you can see on this chart, the relationship is mostly weak or even negative. Pennsylvania, for instance, shows a stronger negative correlation at negative 0.17, suggesting that as mortgage rates rise, home prices tend to decline. However, in Michigan and Georgia, the relationship is significantly positive, hinting at more complex market dynamics. So overall, this chart reveals that mortgage rates are not the only factor influencing housing prices and that the impact varies by state. So this was my third insight, and I came up with a dual line chart that compares nominal and CPI adjusted home prices in California. So while nominal prices show steady growth, the inflation adjusted line tells a more nuanced story. So the first major peak occurred in July 2006, right before the housing crash. Then we see a sharp dip during the Great Recession, followed by a new high in June 2022. So this CPI adjustment helps highlight real purchasing power over time. It shows that although today's prices are higher, normally they only recently surpassed pre-2008 levels when adjusted for inflation. So in this comparison for this chart, the average monthly home prices from 2015 to 2025, we see a clear pattern across both California and Florida. And I saw the same on other states as well, but on this one, it clearly shows March consistently offers the lowest median home prices, with like California at $437,000 and $214,097 in Florida, while December peaks as the most expensive month. This insight could be useful for both buyers and real estate professionals when planning transactions, as it shows a consistent seasonal pricing trend across multiple years. I was just wondering, curiously, why March would have those rates, and I don't know if it could be because people are trying to sell houses before they do their taxes. What do you guys think? So, yeah. So in conclusion, this project reveals that housing market trends are shaped by much more than simple price increases, and by adjusting for inflation and examining correlations with microeconomic indicators like mortgage rates, I gain a much richer view of housing affordability and price behavior. So this kind of analysis is especially useful for home buyers and policymakers. For example, it shows when prices tend to be lower, in this case mostly March, and where growth has been strongest, such as Florida and Georgia, and how economic conditions like interest rates and inflation influence long-term affordability of houses. So all these insights were generated using original and cleaned data from Fred's website and Zillow, and I used Excel to ensure full transparency and reproducibility. Thank you so much for your time. Look forward to hearing your feedback. Thanks.